Chad from Texas asks, as a newbie with limited capital from which to begin investing. Wow. All right. I like the grammar on that. From which to begin investing. That's actually the correct way to say that. And a Dave Ramsey fan, I'm struggling with how to justify investing in real estate, knowing he teaches to invest into things with cash only, including real estate. All right, I had to unpack that sentence for a second. In fact, it would seem that any strategy I'd have to consider to get started would be about 180 degrees from what he teaches. I'm thinking, and he's liking the BRRRR strategy. We'll talk about that in a second. He went from millions to bankrupt with real estate investing, so it's hard to disregard his experience and concerns. Do you have any help thinking this through? I'd appreciate it.
Okay, sure. Well, Dave Ramsey's great. Dave Ramsey, if you're, I think he's on the station probably, but talks about basically manning up or womaning up and being responsible with your personal finances and not overextending yourself and working with cash and cutting up your debt, et cetera, et cetera. And he's been at this for 25 years probably. Mm-hmm. And so he's got an entire, like his first graduating classes are doing real well now. They've been out of debt for more than a decade. They're stockpiling cash. And so I love Chad's question, and I would tell you this. If Dave went bankrupt, and I've read that also, in real estate investing, it's because he didn't take his own advice.
Right.
Okay? He overextended. He probably bought a lot of properties with short-term time frames in mind. Okay? Again, investing in real estate is not just about flipping any more than investing in the stock market is just about day trading. Right? In both cases, the responsible, long-term, tried-and-true method is accumulating quality. Right? Mm-hmm. And that's all we talk about here. So what I would tell Chad is, like, literally think that the next 5 years is all about two things: saving and researching for 5 years. Okay? You can create a fantasy portfolio on renterswarehouse.com. You open a free account. You can add properties into a portfolio pretending that you own them. Track the value of those properties over time. Test your thesis. Try to learn where you want to invest. Get out ahead of it and just save. Cut your expenses. Do everything Dave says. Like, nothing we talk about here is 180 degrees away from what Dave talks about, but most of the real estate investing tactics you'll hear out there are short-term in nature. So blow that up. Forget short-term. If you're young, and again, it sounds from what he wrote here that he's getting into this and it's early times for him. You mentioned BRRR. That's buy, repair, rent, resell, repeat. That's a flip.
Yep.
Okay? That's right. A flip that you rent it along the way, and so you can hang on to it a little bit longer. You could, like, buy something, repair it, rent it out, sit on it for 6 or 9 months. Okay? You don't have to flip it right. You can sit on it for 10 years. Mm-hmm. And then repeat. I would say buy, repair, rent, don't resell, and just repeat when you can.
Yeah.
If all you're able to do is buy one house every 5 years, and you're 25 years old, and you're only going to wind up with 5 or 6 or 7 paid off houses by the time you retire, that's a winning plan, right? You just got to get out of the mindset. Getting out of the mindset of the need for immediate sort of gratification, the need for short-term success. Look at the research and the savings as the metrics that you're measuring to see how successful you are. How much money are you socking away? All right. And what are you learning about where you want to go when you have the money to do it? And I think Dave would probably forgive me for saying that buying with cash is good. Putting 50% down payments down is also pretty good. So if you wanted to increase your velocity here, just don't go talking about 20%, 30%. Go all the way to 50%. You won't go bankrupt. If you buy a quality property in a quality market and the rents covers the expenses nicely and you put down 50%, you're not going to go bankrupt on that. Okay? I can't guarantee it, but if the rest of your life stays in order, that's going to be an income-producing property. You just can't do as many as fast as you might like, which, welcome to the world of being patient to have great things happen, right?
Right. Hey, I don't want to be patient, though. Right? Like, I want things now. I couldn't agree more with you regarding Dave Ramsey and his strategy, right? Like, if you want to be more conservative on the leverage side, I agree, right? Invest 50% in cash and then get a loan for the rest. It just makes sense, though, to borrow when buying real estate initially. it just makes sense. Like you said, you get more velocity, you get more deductions, and quite frankly, it's a little bit easier.
But with a big down payment, you also have enough of a cushion that if it goes vacant for a couple of months while you're finding a new tenant, you don't have a big mortgage payment. It more than covers the mortgage payment when the rent is coming in, and you pay that thing down, you accelerate the pay down on it. The goal, everybody's goal should begin with how old am I, when do I want to retire, and how many properties do I want to have paid off by that time, and then start backing up from there.
The conservative method to investing here, like we said, is the 50% number. Greg, you and I always go back and forth on the 20% versus 30% down payment number. I know you like the 30% for folks that are a little more aggressive, do 20%. Yeah. What do you think, just one more time for those listeners that are just absolutely new, what are your thoughts real quick on the 20% down versus the 30% down?
20% is too low, too small of a down payment. If you play around, again, go on to renterswarehouse.com, go to the investor marketplace, put properties in and play around with the calculators. You'll figure out pretty quick that when you have a big mortgage, i.e. a small down payment, most of your rent is going to pay that mortgage. And I want you to imagine the house going vacant. Okay, you made a bad decision on a tenant, you have 2 months of a vacancy. You're making that mortgage payment for those 2 months. Okay, so people who want to get in early, put in small down payments, take a huge risk that something might go wrong, and then therefore they wind up not having the benefit of positive cash flow. So I just would wait. I would wait 6 more months. If you have enough to buy a house with 20% down today, you'll have enough to put down 30 or 40% in a year. Just wait a year. And don't worry about it. And realize that even though it's a long-term conservative strategy, it's also a super creative strategy. You're tracking population trends. You're tracking glaciers, okay? Tracking glaciers and being right can make you rich. All right, but you're not chasing wildfires here. It's not. If you really need short term, let me introduce you to somebody over at Scottrade, where you can do it in the stock market, where that market, it kind of favors the short term thinker, where real estate punishes the short term thinker.